Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Marc Michel of Runway Venture Partners. Marc, thank you for joining us.
Thanks for having me, Hall.
So what was your background before you started investing in the early stage world?
Well, believe it or not, I started investing in technology stocks when I was 13 years old. And it wasn't because I was particularly interested in technology. It was motivated by the fact that I wanted to buy my father's fire engine red Mustang with 310 horsepower. I asked him how much it was going to cost me. He told me $2,500, and I only had $100 in my pocket. So I started to go down to the library and look for interesting technology stocks to invest in. Started that when I was age 13 and never stopped. After college, I started a job with what became a part of Merrill Lynch, doing technology underwriting for the investment banking department. Eventually moved over to a nascent division of theirs, doing middle market leverage buyouts, and spent about 8 years with that division. Eventually, Merrill got out of that business, and I really wanted to return to my roots in technology and started a $60 million venture fund as part of a money management firm called EOS Partners here in New York. I was there for about 5 years before I got recruited by TD Bank to run and build their growth equity business, which became about a $500 million effort. We did that sort of through the early 2000s. While I was there, I had an inspiration to start a company in the medical transcription business, which had come from watching my father and my brother, who were both physicians, do their transcription basically the same way they had done it my entire life without any advancement in the technology. And so I helped co-found a company called Precise that's still around today, has been extremely successful. We would call it a SaaS company today, but that term really didn't exist back then. We actually called it a service bureau back then. But we used a lot of the technologies or nascent technologies that are now here today, especially voice recognition and natural language programming that were in their sort of infancy back in 1999 and, of course, are much more advanced today. But we started using those technologies back then. I eventually left TD when they also decided to exit the business and started co-investing kind of as an angel with one of my former entrepreneurs here in New York. We eventually built an incubator, and that eventually led to the formation of Metamorphic Ventures, a seed fund here in New York in 2008. And when it was largely inspired by the fact that we had made an interesting observation that the cost of developing software over the prior 10 years had declined dramatically. And this was a function of the fact that cost of computing was declining dramatically, the cost of data transport was declining dramatically, cost of data storage had declined dramatically, all of which led to this thing that we now call the cloud. And so, just as an example, when we started Precise, I think our first product cost roughly $2 million in software development costs. That same product by 2008 would cost probably around $200,000. And today I'd venture a guess that it might only cost about $50,000 to produce. And our view was that that was going to unleash New York in particular, other areas as well, but in particularly New York as a startup ecosystem in a way that New York had really never been a big ecosystem in the past. It was primarily the Valley and then Boston as sort of the number two ecosystem. And those were largely hardware-based products that were coming out of those two ecosystems for a long time. Computing, semiconductors, switching gear, photonics, that kind of stuff. All the kind of things that New York really had pretty weak domain expertise, if not no expertise in. And so New York was really not much of a startup ecosystem. But with the cost of computing coming down so dramatically, we surmised that there was a ton of domain expertise that could leverage that in New York, where New York is a domain expert in a whole variety of fields, from financial services to payments to retail, fashion, media, legal, health, a whole wide variety of domains where New York is a leader, and that when you started to create software around those domains, that New York would take off as a tech ecosystem. And so my partners and I started a seed fund called Metamorphic Ventures at the time. It's been renamed Compound today, to sort of go after that idea. At the time, New York had very few seed funds. Today, I've got a count of roughly 140 seed funds that are operating in New York. And as you well know, New York has become the number 2 tech ecosystem in the country, surpassing Boston at this time, which frankly is much bigger than I really ever expected. If you had told me back in 2008 that New York would be bigger than Boston, I wouldn't have believed you. But we are at this point, and I think we're growing even faster than the Valley. So we had started Metamorphic, raised 2 funds there. I spent a total of 8 years there, and then left in the beginning of 2016 to form Runway Venture Partners. And the thesis for Runway was sort of twofold. One, we really saw this opportunity in SaaS taking off, and we thought it was only going to get bigger and bigger. And I believe that more today than I did even then. And the second thing that we did, or area that we were focused on, was a problem that we saw developing in the venture sort of capital markets, if you will. So while there was a ton now of seed capital to be gotten in New York, the Series A capital was getting harder to get, not easier to get. And that's largely because after about a 10-year run of prosperity in the venture market, a lot of the funds that had used to write checks of about 4 or 5 million and lead Series A rounds of that size had now doubled and tripled in size. And so what happens is that they don't write more checks, they just write bigger checks. And so today, I think the data says that the average A round is about $11 million. And I've seen a lot of $20 and $25 million for the Series A rounds, so some even larger than that. But the average is $11 million. Well, that has caused and is causing some pain for the seed-funded entrepreneurs, because they might raise $1.5 million or $2 million and be able to put their product in the market, get to a certain size, but that size isn't large enough to attract and qualify them for a $10 or $11 million Series A round. And even though it's called a Series A round, that really would have been the size of an old Series B round 5 years ago. So by no fault of their own, the market has sort of moved away from them and created this gap. And so we saw an opportunity to fill that gap with Runway Venture Partners and come into SaaS companies that had proven a level of product market fit, but needed another year and a half of seasoning to qualify them for a Series A round. And so that's really where Runway focuses its attention, largely in B2B software companies, primarily SaaS companies that are post-seed but pre-A, in which we will typically lead a $3 million round. Our typical check size is about up to $1 million. We'll catalyze that round and typically go on the board of that company.
And so what exactly do you look for in companies that fit that thesis? What's the criteria that separates the ones you invest in versus those that you don't? Because to your point, there's quite a few out there right now.
Absolutely. So we are looking for companies that we think have developed a very unique product that is defensible over a long horizon, because it takes a long time to build these companies into market leaders and sizable companies. So that advantage needs to persist from a technology point of view. Obviously, we are looking for a very strong leadership team with particularly emphasis on product expertise to drive the product vision forward. But then we are looking for a certain level of product market fit. So we're not looking actually for a specific level of revenues, but enough proof that they know that they have proven that customers are willing to buy the product and that customers will attest to the fact that the product is solving a large pain point for them and that there are not dozens of competitors that they could have chosen out there. So we look for technologies that are solving a problem in a very unique kind of way.
Are there specific startups that fit that thesis? A couple of portfolios that really stand out in your mind as good examples?
Absolutely. I'll take two to begin with, Scope Now and Market Muse. To start with, Market Muse is an AI company that helps business writers who are writing content for their companies to drive both thought leadership as well as traffic to their websites and ultimately to drive the top of the funnel for a sales effort in their writing efforts. What Market Muse does is essentially create an outline that would typically take a couple of months of work to do so that a writer can get started very, very quickly and write an article that is going to score very well with Google's semantic analysis engine. And it'll put their content at the top of the search engine when it happens. It sounds simple to do. It is very complex to do, and it takes quite a bit of technology in order to create an outline for an article. The next iteration of this product is actually to do a first draft of an article so that the writer can produce even more quantity with higher and higher quality over time. We're not actually trying to replace the writer, but at least get them going to start with.
So what are the challenges in the SaaS space today? Of course, it takes a while to get the company up to altitude, so to speak, and a good solid base of customers. But beyond that, what do you consider the major challenges your portfolios face?
Yep. So we invest across almost every vertical. And the reason is that the sales process for most companies is almost identical. And where we really lean in from an operational point of view is in the marketing and sales effort for these companies. Most of the companies that we invest in have a very unique product, and when we get there, have proven that they can make a handful of sales. Largely, they've been founder-led sales. And what the companies struggle to do is move from founder-led sales into professional management-led sales. And so we spend a lot of our time helping the company recruit that team and put in best practices on the marketing and sales front of the company so that they can scale. Because obviously a founder cannot run sales for the rest of the life of the company and hope to become a significant business.
So for those investors who are considering investing in the SaaS space in general, what's your advice for people that want to pursue that?
Well, if they've never done it before, I always like to tell people, regardless of what sector you're investing in venture is a 1% business. Most VCs will look at 100 companies for every one that they invest in. And so one needs to really create a large amount of deal flow in order to put together a high quality portfolio. And there's a certain pattern recognition that comes from looking at literally thousands of companies in order to build a portfolio of 20 companies. You need to be willing to put in the effort to look at that many companies in order to build a high quality portfolio. And venture is also a portfolio business because the very nature of it is even the best of us are going to get it wrong a reasonably significant percentage of the time, somewhere between 30 and 50% of the time, we will get it wrong. And so someone starting out is likely to have an even higher miss rate. And so it's absolutely critical that if someone's going to do this on their own and is coming from kind of a background of never having done it, that they invest in enough companies to build the diversification for a successful venture portfolio.
So you invest across SaaS, across a number of subsectors and applications. Are there any particular sectors or applications you think are ripe for opportunity at this stage?
So we're broadly bullish on how software is basically re-engineering all sorts of different industries, whether it's traditional industry, healthcare, marketing, fintech. We just see opportunities sort of across the board for software to re-engineer processes and make them so much more efficient than they used to be. I think, though, that where most of the SaaS companies are going in terms of taking it to the next level is really adding in machine learning, data science, and AI capabilities into their products. There is just so much data exhaust that virtually every company puts out there. And there are huge opportunities to use that data to create even more value in their businesses. Most of the companies I see today have a data scientist and are employing what I would call applied artificial intelligence, meaning that they're not trying to create core deep learning technology or neural network technology, but they're using the technologies that are going open source from companies like Google and Intel that are publishing those technologies, using those AI technologies to bring new value to their customers.
How best for listeners to get back in touch with you?
You can reach me through LinkedIn. I believe my Runway email is listed there, and I do check it frequently, and we have found a deal or two through LinkedIn.
Well, that's great. I'll put that in the show notes and hope to have you back for a follow-up soon. Appreciate you sharing your thoughts with us today and hope it goes well for you.
Thank you, Hall. It's been a pleasure.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.